What up, peeps? Swizzle here, Dan there. I'm all knotted up because I'm going into New York City for CNBC's Fast Money. That's 5 o'clock Eastern time. Means if you're out on the West Coast, it's 2 o'clock. I don't know what frickin' time it is in Hawaii if you're watching. I mean, you're probably not watching because you're in Hawaii. But this is Market Call. Today's episode is brought to you, Dan, by CME Group. I love this. Remember that Laird Hamilton thing? I dig that. And they're people on the golf course putting where risk meets opportunity, and our data partners at FactSet. If it weren't for FactSet with all the fancy charts and all the things they provide us with, I don't know if we'd be able to do the market call. But how are you? By the way, it's election day. I know you know that.
I do. I already voted.
If you don't vote, you're part of the problem. Keep your mouth shut. Don't complain. But I'm sure all of our listeners and viewers have voted. I voted as well early this morning, right before I went to Starbucks to get one of those medicine ball things.
Oh, really? You're all tuned up here. You know, Guy,
Can I tell you something? I am so freaking tuned. I am tuned up.
Well, we have a big afternoon. Once we get done with Market Call, we're probably going to do a little podcasting. I know I have one with our main man, Rick Heitzman, and then we're going to do Fast Money together. And just so the people know, Carter Braxton Worth is sitting on the desk today for the full hour on Fast Money.
Yes. No,
And you know, Guy, I asked you, I said, Carter and I are going to go have dinner afterwards, and you're not joining us. You say, I'd love to join you. You said, I'd love to be a part of that, but you know that I just can't do that. That's what you said.
Yeah. And then you say you're really strange, and I am strange.
You are strange.
I'm quirky as hell. It's not, I just,
Well, here's the thing, Guy, like we will dine without you. We will
have a great time.
Yeah.
All right. Have a better time without me than if I were there. It's just fact. No,
that's not it. But here's the fun thing about Tuesdays. We do it for CME. And like you said, we all have all the tricked out data from the FactSet company. But we also look at the markets through the lens of the futures here, and we got to look at these S&P futures here because it's been a nice 2-day run here, Guy. And we've been talking about throughout the last few weeks, you really kind of nailed that mid-October rally here. And it's funny because, it doesn't feel like we've had the sort of oomph that we had over the summer as far as from that mid-June to mid-August rally. We had about, 11% or so into mid last week, and then we kind of rolled over here. But the S&P, due to some rotations out of mega cap tech, has acted a lot better than the NASDAQ here. So you see that declining 200-day moving average. You see that downtrend that's been in place since the beginning of January. Are we going to get through last week's high? And are we going to get back to that downtrend? Because I think both you and I think you'd sell them and then sell them again if we get back up to those.
Yeah, I mean, obviously now everybody's talking about, this election being a potential catalyst for the next leg higher. I guess. I mean, I don't think there are going to be any surprises. I think whatever the outcome is, I think it's pretty much anticipated by the market. But look, I've said that before and I've proven to be wrong. But to answer your question, any rally on the back of this or any perceived rally on the back of a Federal Reserve that's going to pause, CPI is such a huge, as big as the election is for our country, I think CPI is much more important for the broader market. So I'll hold off until we see that number, which I still think is going to be hotter than people anticipate. So we talk about this rally. Yeah. I mean, we mentioned it the 13th, 14th, and then subsequently Monday, the 17th of October. We said what we thought was setting up. It's been not nearly as dynamic as the rally we saw in the summer, but that doesn't necessarily mean anything. Now people are talking about seasonality. I think you throw all those things out. If CPI comes in hot, we're headed lower. It's just that simple.
Yeah. So interestingly enough, I mean, if you look at the 5-year chart of the S&P futures here, you and I are both in the camp that, things got a little overdone in the near term. A few weeks ago, again, I've not been that impressed with the rally because it hasn't been with some of those mega cap tech names. And I think both you and I agree that, we've needed to see those things really fall out of bed the way Apple has just done so in the last week since it reported its earnings after it had that initial gap. But you look at that 5-year chart, I think you and I both think we're going back towards 3,400, maybe 3,200. I know a lot of, real like staunch bears think that if the S&P multiple troughs at 14 and we have $200 in S&P earnings, well, that goes below, the kind of levels that we're thinking about. But again, you know what? Near term, you got to be able to kind of, move around. Like, you got to be able to move your feet, because the last thing you want to be doing is pressing a market near those lows. I'll just say this, guy, you mentioned the VIX a couple times over the last few weeks. We don't throw charts of it up there too frequently, but it just seems pretty simple here. When the VIX gets to 35, you buy stocks. When it gets down towards 20, you sell them, right? And so when you think about this range, I mean, maybe this is just suggesting, and if you look at the next chart here, we overlaid the VIX versus the S&P futures here. If you get a few more ticks lower in the VIX, maybe towards that uptrend near 20, you get the S&P back towards that downtrend, and that's the level. You kind of, when these things have made. What do these two charts look like to you?
That's it. Listen, that's exactly right. And I think the reason why we talk about the VIX is not for people to trade it, and it's not for some instrument that you can be, I don't know, investing in, for lack of a better word. It's to have it up so you can exactly see what we're talking about here. When VIX is, and we've talked about this a number of times, the last two times the VIX has gotten to 34, 34 and a half, that's been your opportunity to get long stocks, and the air seemingly is taken out of the volatility index, and that's happened. Now, you're right. I would submit if the VIX were to get down to 23 and a half, 24, that's going to be your opportunity to get out of stocks. And I think that's going to be proven to be correct as well. So again, we're not advocating trading volatility, but you have to have it up to understand sort of the thought process of the market, and to a certain extent, the emotion of the market as well. And real quick, Dan, because we had Nouriel Rubini on the Tape podcast, a special drop yesterday, and we said the first 100 people that left a review for our On the Tape podcast, we get a book. It's unbelievable how many people have left a review. So don't be the last one in line. If you want Nouriel's book, peeps, leave a review, take a screenshot, send it to Amanda. You'll get a book. It's just that simple, Dan Nathan.
Yeah, no, it's a great read, actually. It was a great conversation. So check that out too. Guy, we just kind of mentioned, the underperformance of late in mega cap tech. We know that most of them did not have good earnings. We know that the guidance was not great. We know that analysts guided or took their estimates down in accordance with that guidance. You look at the NASDAQ 100 futures here. We have a 1-year chart, guy, and you look at this thing, the bounce off of the lows just in the last couple of days, or take it back to that October 13th reversal day, not particularly impressive here. And again, the one thing I'll just say, and I know market call viewers know this, I've been picking at some of those big cap tech stocks. I bought some Meta, I bought some PayPal, I bought some Amazon, and I bought some Alphabet after they reported here. Again, all of those names contributed to this relative underperformance. If the market were to rally, do I think that it basically probably grabs the baton from those like the rotation that we saw into the S&P? Probably. But again, I think you got to be really careful here, because if this thing reverses, the NASDAQ will lead the broad market lower.
Yeah, I mean, the bounce has been not all that inspiring, obviously. And it's funny because Carter talks about the Dow Jones. And again, we're not trying to be geriatrics here, but the Dow Jones has completely outperformed the NASDAQ. And it's for a number of different reasons, not least of which the underperformance of all the stocks we talk about, and now this downturn in Apple. So this has not been a very inspiring bounce at all. And again, this looks like to me is there's going to be another leg higher. And I don't necessarily think that there's anything out there right now, short of some detente in Russia, Ukraine, or some sort of, again, detente with China, that's going to get these tech stocks moving. So a lot of them are still expensive. And I would submit this is actually telling the real story of the market right now, Dan.
Yeah, it is interesting. Today, though, Guy, Apple was lower. Meta, after having a big day, was lower. Tesla was lower by almost 5% after being down 5% yesterday. And a lot of them have reversed, and kind of Tesla is only down 1% or so now, but Meta's green, Apple's green. And again, I mean, you can keep trying to pick at, bad stories on the short side. I'm kind of more inclined to kind of define your risk. I kind of feel like, near term, until we see maybe a little bit of overboughtness in some of those names after an extreme period of oversold, I don't think they're great presses on the short side. But here's one, guy, I've been wrong on this, on yields. And this is a really important part of this, because when yields also started getting above 4% in the 10-year over the last few weeks, that has really put a level of pressure on, I think, expensive tech stocks, mega cap tech stocks, that sort of thing. If we're finally to see this 10-year break that uptrend that's been in place, since August. It was probably 270 or something like that. We just ticked at 421 yesterday. We're down about 10 basis points. I mean, to me, again, I'm long GOVT, I'm long calls, I'm playing for lower yields here. It's just been really stubborn. And, at a time, Guy, where, the CME Fed Watch tool right now for the Fed FOMC meeting is basically 50-50 on 50 basis points versus 75.
Yeah, this feels like, well, it's interesting. So yields are lower today. The TLT is probably up close to 1.75% if that's the instrument that you look at. And I think to a certain extent, that's why the market's rallying. It's taking its cue from yields going lower. But I think yields going lower here is sort of people getting ahead of anticipating whatever happens in this election, and then people potentially getting a little spooked by what potentially could be a softer or not as hot CPI number. I think that's on Thursday. So that's my take. I think yields should go lower, but the reasons I think yields should go lower is because, listen, the economies are slowing down, and yields shouldn't be here in a slowing economy, not only here, but across the world. So I do think yields are going to go lower. And what I've said for a while is the knee jerk will be for stocks to go higher, which to a certain extent is what we're seeing today, until people come to the realization that yields going lower is not bullish. And that's something that Carter Worth has said for a while. And it's something that Danny Moses on the Tape podcast has said a number of times as well.
Yeah, I guess where I would differ in that is like if it went to 3.5% is just some sort of reorientation about the pace of what the Fed is going to be doing. And again, I know Fed funds is obviously much closer tied to, let's say, the 2-year. I feel like that's not a disaster. It would probably be a good spot for equities in the near term, especially in an environment where pessimism is still really high. But, one aspect of that, Guy, is like, we talk about this uptrend in the 10-year yield. Look at it in the US dollar index here. Okay. So we're through the 50-day moving average, and we're right on that uptrend that's been in place since basically the start of this year. I think a break of that trend, we've already broken the 50-day, which has acted as really good support for most of this year. If we're to break that uptrend and then maybe head back to those kind of August lows or so, which might be very near the 200-day moving average, I feel like that might be a precursor for yields going lower.
The two are going to be, listen, the two will be, they're linked at the hip, right? I think to a certain extent, the dollar trumps everything in terms of the impact it's going to have. But you're right. Here we are right on that trend line. The 200-day moving average probably comes in around 104 or thereabouts, I would submit. And again, this hinges entirely not on the election, but on the CPI number. So if CPI is interpreted as soft, you're going to see a pretty significant move in the dollar and in yields and probably in equities as well. But if CPI comes in line or slightly higher, I think this trend line is going to hold up. I don't know. So let the trend line be your guide. If we start to trade through it ahead of this number, that could be a bit of a tell. But I don't think you're going to miss it. So to try to game it here, I think to a certain extent you're flipping a coin. Although I will tell you, I'm more inclined to be long the dollar here against this trend line than to short it through the trend line.
Yeah, well, I mean, I'm long puts in the UUP, the ETF that tracks it. I'm sticking with them. The trade's working here. And I feel like this is one where I want to play for a move back towards that 200-day. I really do think, again, I remain very bearish on S&P earnings. I remain bearish on the global economy. I remain in the camp that the S&P will come back and retrace back towards that 3,400, probably overshooting. You and I have been consistent on that. As traders, we like to think about how we can be opportunistic, right? I'm still playing for that move lower in yields. And I think that if you do have a number in the CPI that's a bit softer, I know there's a lot of comments in here in our chat with people suggesting that Tom Lee's saying it could be softer. I think that any continuation, if we do have a rally tomorrow on the back of, let's say, the election results and the CPI is softer, we're going to rip into the end of the week. You know what I mean? And again, I'm not saying you buy, that Thursday at 8:30 if the number is softer, especially if we've already rallied considerably in the last few days. But that's just how I've been positioned. And in that environment, I make money on lower yields, I make money on lower dollar, and I make money long, let's say, the Amazon, the Meta, and the Google.
If CPI comes in significantly softer, so a few ticks softer, I think the seasonality will kick in, the pent up whatever will kick in, and you potentially could see the year-end rally that everybody is craving, without question. I think it'll be misguided. I don't think it would be based on any fundamentals other than the fact that maybe the Fed is out of the way. But if you really start to examine what companies are saying and what companies, more importantly, are doing, and that is layoffs, obviously margins have been coming in. It's not a bullish environment for stocks. I mean, it'll be a bullish in the short term, but I think at a certain point, again, people will come to their senses. The problem is, now that we're in November, when seasonality kicks in on potentially the back of a softer CPI, elections are over, animal spirits can take over without question. By the way, we saw it last year as well, Dan. I mean, that rally into December and then into early January did not make sense at all. I mean, it left a lot of us scratching our collective heads. That last 6, 7, 8% in the S&P was without question a bit of a head scratcher, but it happened nonetheless. And if you were long stocks, you prospered in that. So can it happen again? Yeah, it could. I don't see it, but it doesn't mean it can't happen.
Yeah, and I guess, market call listeners, viewers will, kind of remember you and I've talked about this a lot. I mean, we're talking every day in markets, and we have to be able to kind of keep a broader framework, but identify what's in front of us, what's happening. And I think that what we do a nice job of is kind of identifying shifts in sentiment right now. And I don't think there's any shift in sentiment from a fundamental standpoint. There might be in the not so distant future as it relates to what the Fed is going to be doing, and that's going to be dependent on the data. But when I think about all the negativity about earnings that you and I thought was going to happen, we thought that some of these big companies were going to miss and guide down, and maybe the broad market, or at least investors, would start to kind of take some profits, or just kind of see what's in front of them as it relates to the earnings outlook for next year. So all that's happened here, but sentiment was really bad a couple of weeks ago. And so what we're not going to do is we're not going to be the guys pressing the lows. That's just not going to happen here. We can keep our broad bearish framework, but we can also identify some opportunities to take the other side of things. One of which, guy, was gold. And again, you're going to say, well, I had gold wrong a couple times here. But again, over the course of the last year, you had it really right last year. Okay. And so there's been opportunities to play for some counter trend rallies. And I think you've done a nice job of that. You also thought that this double bottom that we've had over the last month and a half or so, you look at the gold, this is the gold futures, you look at the move above that downtrend that's been in place. And then if you look at this 5-year chart, that's some pretty good support we just bounced off of, right? So what's your setup in gold here? And I know that it has a lot to do with what's going on with the dollar also.
Yeah, listen, I have no idea. Yes, I mean, dollar's part of it, without question. I can't tell you what this last move in gold's been predicated on, because it's had a number of opportunities over the last 6 months to bounce on more bullish environment, and it didn't. So why is it happening now? I have no idea. Did it hold levels of support? It absolutely did. And is it telling a story? Maybe. It's interesting. It's somewhat decoupling from Bitcoin. So maybe the Bitcoin move in some ways has been gold bullish. Again, I don't know the answers. I'm sort of grasping at straws here. But what I will tell you is gold to me is still something you want to be in. And gold's not a story until it is. And if you look at the mining stocks, and I don't know if we can do this on the fly, but here's the GDX. We obviously can do it on the fly. I think you'll look at this and say, wait a second. We made a low. Then over the last, since, I don't know, mid-October or so, we've had a series of higher lows, and it looks like it wants to trade back up to those levels of support. So past support becomes resistance. We probably find it in the GDX around 29 or so. But then we're going to start talking about the 200-day moving average coming into play. And can we see levels that we saw in the spring? I mean, the individual names are doing extraordinarily well. I mean, if you look at some of the mining stocks that not associated with gold, a name like Freeport's done well over the last couple of days. So there's clearly something going on. I think you just got to stay with it here, Dan. And it's been a tough one to own for sure. Here's a chart of Freeport-McMoRan right up against the 200-day moving average. So again, just something to look at, a stock that had this bottoming process since the middle of the summer.
Yeah. Hey, let's go back to the 1-year chart of the gold futures here. If you were in your old seat, guy, trading gold here, and you're looking at that really pretty powerful, breakout above that downtrend that's been in place for, over a year and a quarter or so. I'm looking at this thing that was trading, I don't know, 1620, okay, 4 or 5 trading days ago. It went through its 50-day moving average. It's right at its 100-day moving average, which is 1720.
Yeah.
And you see that nice round number of 1800 or so, which was the August high. If you wanted to play this for a continuation, where might you set the stop in the futures, right? If you were
That trend line.
saying,
I mean,
yeah,
that's the right question. I mean, your stop is now, well, the right stop is those two lows. The lows we saw in late September and then the subsequent low we saw in late October. Whatever
yeah.
that level is, I don't have it in front of me, but it's probably
No, it's about
17,
1620 or so here.
1620. I was going to
Yeah.
say, okay. So
Yeah.
there you go. So that's your first level. But if you want to be really disciplined, the real stop comes in the form of a breakdown through the downtrend line. So the trend line we just broke to the upside, your stop should be theoretically either those double bottoms or if you want to be tighter, more close to that trend line, breaking that downtrend line to the downside. That's how you play
Yeah.
it. But I will tell you that if you want to be really aggressive, this is one of those situations where you can buy into strength as well. So if this continues to go higher, then you can add to a long position. But that's sort of the levered way to
Yeah.
play it. But that's exactly how I would be doing it.
Yeah, and I guess the other point when trading futures, and again, you and I spent some time earlier in our careers trading a lot of them. I mean, the ability to set stops, right, and so makes a whole heck of a lot of sense. It's one of the reasons why we look at the charts, because a lot of people are looking at a lot of the same levels, and we know that stops are placed in technical levels here. So to me, when you have a winner in something like that, you can keep raising your stop also, which is the other thing. So again, I think that's pretty useful. You just mentioned gold decoupling from crypto, guy. And I saw you tweet this last night, like WTF is going on with Bitcoin, big downdraft here. Amanda put together a nice little hodgepodge of some of the headlines that's going on. So Binance this morning, one of the largest exchanges, just agreed to buy FTX, and one of the other large retail exchanges. There seem to be the two CEOs of these companies, pretty famous guys in the crypto space, have been beefing a little bit, guy. And Binance owns a bunch of the stable coin at FTX, which is FTT, and it's just been this back and forth. And then Binance is stepping in now to buy FTX because of liquidity. It just seems like a big old-fashioned mess. Bitcoin sold off on this, and again, I mean, this is the sort of thing where you got to think about, okay, this is a huge pocket of interest and exuberance as far as investors last year. It's coming undone right now. You see Bitcoin banging around or this 19,000 sort of level on the 1-year chart in the futures. Thoughts on this whole thing? Because again, Danny Moses, going back to our co-host from On the Tape, he's been talking about issues in the collateral for these stable coins for a while, and the ability for it to kind of unhinge this market.
Yeah, there's definitely more to this story. We're going to learn. There are going to be more chapters written about this over the next couple of weeks in terms of what really happened here, and how this whole thing was set in motion on some random Monday night. But in terms of Bitcoin itself, I mean, we've said this for a while. I mean, Bitcoin has been mired in this range for quite some time. So the bulls will say we're putting in a base here. And we're getting ready to take on the 200-day moving average. The bears will say this is just a pause before we go lower. Carter's one of those people, and he's been right. I honestly don't have really an idea. I'll say this though. Again, if you think CPI is, if your premise is CPI is going to come in a lot cooler than expected, I think you buy Bitcoin here with both hands under the sort of the theory that will take the Fed off the front burner, put them on the back burner. And again, things like crypto can go back to their, not parabolic, but they're in lower left to upper right mode. So that's how I look at this. Now, again, I don't know, but if you have that belief, and if you want to put that belief in motion, you buy Bitcoin here thinking that potentially we can see a soft CPI number on Thursday.
Yeah, and I guess the other thing, when you're looking at this 5-year chart, though, you also see going back to, kind of late 2017, when it was right around these levels, and that was the top before the latest crypto winter. The idea of using futures and then again setting stops and not actually being as kind of dependent. I know there was a lot of FUD, as the crypto people,
what does that mean?
That fear, uncertainty, and doubt about having your
know.
coins at some of these exchanges
FUD.
if there was a run on them and they were to fail. But if you were going to play via futures, you could put stops in, you get the leverage, all that sort of thing. So to me, that makes some sense only if you are using stops, people. Okay, Guy, let's move on a little bit. We only have a few minutes here.
Okay, before can I call an audible here? You know where there hasn't been any FUD, and this is just going to show you how great Jacob and Amanda are in unison. Look at a chart of Amgen, AMGN. It comes out, and why do I mention that? Because we've talked about biotech stocks for quite some time. We've talked about this one probably being the best in breed, and it was sort of ready to, what you call it, Dan, party, and that's exactly what's happened. So you got your move today in Amgen, and it's, by the way, it's not just a name like Amgen. You're seeing new all-time highs in Merck, Eli Lilly, Bristol Myers. Put up a BMY chart, name we've talked about for a while, also breaking out to the upside. So there's been no FUD in big cap pharma and some of the associated biotech names. Back to you, Dan.
Yeah, and it is interesting for people who tell you that technicals don't matter. They do. When you just saw those charts, I mean, the power of the move on top of the breakouts on all of those names is pretty remarkable here. And a lot of it has to do with the fact, and Carter talks about this all the time, is that, people have memories, right? They have memories of buying stocks at prior highs and then riding them lower. When they get back to, certain levels, maybe they sell. That's why you have that tension at those resistance levels. But when you get through, you have the sort of thing like you saw in Amgen, especially if there's any fundamental news. Guy, I want to talk about crude here a little bit. And I have a trade on the XLE. I don't know if we snuck this one in on you. I don't know if you saw it in our prep here, but I was saying that I don't think crude acts that well right here. I know it's kind of had this little rally, and I know you've been all over the XLE, the large integrateds. That's primarily, Exxon and Chevron. You've been pounding the table on those for weeks and weeks and weeks. Also, oil services, the OIH, which has had this huge move. That's up more than 50%. The XLE is up more than 30%. This is just in a month. And to me, I just think this sets up for a really good trade lower in the XLE, Guy, on a purely technical basis. But I want to define my risk here. And I think there's a good chance that if crude were to come in for any reason, maybe it has to do with growth, maybe it has to do with something going on geopolitically, I think you have this XLE testing 80 in the next month or two. So to me, again, I want to divide my risk. I want to play on these technical ranges. When the XLE was trading around 93 today, I bought the December 30th. Okay, that's right before year end. That is not December regular expiration. 90.75 put spread. I paid about $3 for that. I bought one of the December 30th 90 puts for about $3.60. I sold one of the December 30th 75 puts about 60 cents. Again, $3 in premium is what I paid. I break even down at 87. I have gains of up to $12 between 87 and 75 with a max gain of $12. Below 75, losses of up to $3 between 87 and 90 with a max loss of $3 above 90. What I like about this trade idea here is that I'm risking about 3% of the ETF price with break even down about 5% and a max potential gain of about 9% if the ETF is down all the way down there at 75 in a little less than 2 months here. So again, playing off some technicals. I'm playing off the fact that I think sentiment is way too bullish in this space right now. It seems like by the end of the year, investors may be looking to rotate into other areas that didn't work this well this year. Guy, thoughts on this trade idea?
So you wear this hat much better than I. I'll ask this question. Are you getting paid enough to sell the 75 puts to and I only ask that because if you're right, do you really want to have that? I guess my point is this. You're obviously offsetting some of the cost of buying the puts for $3.60 by selling the 75 put. I totally get that. And my pushback would be, if you're right, do you need to have that on?
So quick one.
Are you going to want to have done that? And are you limiting your upside vis-a-vis that 75?
I'm perfectly fine with it, and I'll tell you why. So here's how I trade these sorts of things, okay? So if this were to drop pretty quickly and let's say go to like the low 80s or so, I would either look to take the whole thing off or take half of it off, that sort of thing. So for me, with selling that way downside put, the likelihood of that being in the money is not particularly great, but it definitely helps offset some decay as we get closer to expiration. And so I like to use a mental stop of about 50% of the premium that I spent for a long premium trade. So that helps me it helps me stay in the game a little bit longer here. So again, I'm not going to be waiting for this thing to go to 75 to take a profit either, but it's a great question. What do you think directionally here? I know that you are bullish of oil and oil stocks, But is it one where would you be buying this breakout right here, or do you like me being a little bit contrarian
No,
here?
I think I like what you listen. Again, there's obviously a dogma associated with this for me. I'm predisposed to think. My thoughts are very bullish in energy, and they have been for a while. But if I were to just look at this and I didn't know what it was, and put that XLE chart back up, and you said this is just a chart of whatever, what would you be doing here?
Yeah.
I'd say, well, you know what? We've reached resistance level. You got to
Yeah.
be taking some money off the table, and if you're really aggressive, you got to be playing for sort of a back and fill, sort of a 50% retracement off that $70-ish low and this recent high. So that gets you to 80. I mean, literally, so all the
Yeah.
things that you've put out there are exactly right. So again, to answer your question and taking my emotion and dogma out of the equation, I think you're doing the exact right thing and you know what your risk is. So I think it's a well thought out trade. So we'll see how it shakes out. One of the things I've said for a while, again, not that it matters, I think the next leg higher could be on the back of the elections being over, but that's probably a conversation for another show. To answer your question, I think this is well thought out. I think the risk reward is good, and I think you expressed it in the right levels as well.
All right. Well, we will continue to
By the way,
update.
somebody said, "Whoa, deep options versus common question." I think that's millennial market. I love that when people say that. I actually am thinking it through because they know that I tend to be not as esoteric and intelligent as you.
Yeah, listen, we love these comments. Just we're reading them,
I
and
dig the comments.
hopefully we'll try to incorporate at least some of your ideas into some of our commentaries we think about preparing for, let's say, tomorrow. So we really do appreciate your participation. All right, Guy, before we get out of here, we got to look at Disney. The report after the close, again, an implied move about 8%,
Yeah.
which is not small for a company like Disney. Now, if you look at this 1-year chart, you see it was nearly a matched 52-week low. So that looks like a bit of a double top. It got just barely below that downtrend that's been in place for this year here. Maybe it's a pair of twos here. It's a tough one to call. But if you think about the I don't know, I mean, the rally that Netflix had, that was one of the few bright spots, if you think about it, and you called that move here. What do you think is going to happen if this company is able to guide higher? I know that, Shanghai Disney, some of this park stuff and the cruises and all that stuff is still down, but it really is a story about Disney Plus at this moment.
Well, it's a big part of the story without question. The last quarter, if you remember, the stock I think got up close to 130 on what was a really solid quarter, and then obviously subsequently gave the entire thing back. What do I think? I think you got to play it from the long side again. I know there are a lot of people that think, how can you do that in this environment? Disney again is not immune from the ills that are facing the consumer and the broader market. I get it. But on valuation alone, if they come in and say anything remotely good, again, my opinion, an 8% move on this stock probably gets you to what, 109, 110, and that takes you right to that trend line. So, yeah, I think you play it from the long side and then see what happens if and when we get there. That's how I'd be looking at it.
Fair enough. And just real quickly, Guy, looking at a 5-year chart of this thing, it just shows the devastation, from those highs. It also shows all the excitement about Disney Plus. When you see gaps to the upside, it was always because numbers were better. And then some of those gaps lower where they came in and disappointed. If you look at this, you look at that double bottom in and around 90. And if you look at that pandemic low in March of 2020 near 80, I almost want to play this kind of like Nike here. So if you're inclined to be long it into the print, maybe you're long like a quarter of a position or so, because if the stock were to come in kind of hard in that kind of support zone, I think you want to buy it in that kind of 80 to 90 range. So with an 8 handle, I got a little cute a few months ago. I was thinking about, oh man, it really was going to break. It didn't. Had that nice rally 2 times, 2 decent rallies here. So I guess I'm on the fence. I'd be more inclined to buy it on a gap lower, but maybe that fundamental news is not the reason why you want to buy it, as you say all the time here. But that's what makes a market, Guy.
Something, you sound like G Swizzle now. That's what makes a market. By the way, I just want to point out Rangers Islanders tonight. Islanders beat the Rangers and the Rangers, and I tell you what, they have not played what I think has been good hockey all year. So I'm not very happy with what's going on at Madison Square Garden. The Knicks showed up in Minnesota last night. We're draining threes left and right. Somehow it looked like Steph Curry was manifesting himself in a Knick uniform. I know you don't care about that, Dan, and I'm sorry to do that to you people, but that's it for today's market call. I'm headed into New York City, knotted up, purple tie, getting ready. I want to thank CME Group for sponsoring this episode, and obviously FactSet for providing all the charts and data. If you enjoyed today's episode, today's video, be sure to hit the link button and leave us a comment and subscribe to Risk Reversal Media. Smash, can't believe I'm just saying that. Smash the like button. Now, typically on Wednesdays, we have Tom Sosnoff of Tasty Trade. Not tomorrow, people. Tomorrow at 1 o'clock, we'll be here with Tony Batista, not the guy that played baseball for the Toronto Blue Jays. So shut your trap. Tony Batista of Tasty Trade. Dan, we'll see you then.
See you tomorrow.